$1. That is all it takes. One single dollar of extra income, and your Medicare bill can jump by more than $1,000 in a year. That is not a typo, and it is not a mistake. It is a real rule, working exactly as written, and it blindsides careful retirees every single year. Let me show you how it happens. You are retired, you did everything right, and one ordinary afternoon, you make one simple money move. Maybe you convert a little of your traditional IRA into a Roth. Maybe you sell a stock that finally did well. Maybe you just take the withdrawal the government forces you to take. Nothing reckless, just a normal Tuesday. Then about a year and a half later, a letter arrives from Social Security. Your Medicare premium has jumped, not by a few dollars, by hundreds of dollars a month, all because of that one small decision, and a line you never even knew was there. That trap has a name. It is called IRMAA, and it is one of the cruelest little traps in the whole retirement system because it hits you on a delay, it hits you like falling off a cliff, and almost nobody sees it coming until the bill is already sitting on the kitchen table. I'm Henry Cole. In the next few minutes, I will show you exactly what IRMAA is, why a single dollar over the line can cost you $1,000 or more, the everyday decisions that quietly push good retirees over that edge, and the one simple form that almost nobody knows about that can fight this surcharge, and sometimes erase it completely. One quick note before we dig in. This is general information, not financial, tax, or legal advice, so always check your own numbers with a professional you trust. Now, let us start with the big question. What exactly is IRMAA, and why have so many people never even heard of it until the day it cost them? Let us clear up that strange name first, because it sounds like a person. IRMAA. It actually stands for the Income-Related Monthly Adjustment Amount. And underneath that mouthful of government language is a very simple idea. It is a surcharge, an extra fee added on top of your normal Medicare premiums for one reason and one reason only. Your income crossed a certain line. Here is how most people picture Medicare. You turn 65, you sign up, and everyone pays the same basic premium for Part B, the part that covers your doctors, and a separate premium for Part D, the part that covers your prescriptions. And for millions of Americans, that is exactly how it works. But what almost nobody is told, until it happens to them, is this. If your income is above a certain level, Medicare quietly charges you more. Sometimes a little more, sometimes a lot more. That extra charge is IRMAA. Now here is the first thing that makes it so sneaky, and you need to hear this clearly. The income they use to decide your bill is not this year's income. It is not even last year's income. Social Security reaches back and looks at your tax return from 2 years ago. Let me say that again, slowly, because it catches almost everyone off guard. The premium you pay this year is based on the income you reported 2 full years ago. So the money you earned back then, in a year, you have very likely stopped thinking about, is the number that decides your Medicare bill today. A retiree paying their premium in 2026 is being judged on their 2024 tax return. And that 2-year delay is the whole reason IRMAA blindsides people. You make a financial move today. Life moves on. The seasons change. And then, a year and a half later, the bill lands, long after you have stopped connecting it to the decision that caused it. By the time the letter comes, the cause feels like ancient history. And here is the second trap. The income they count is broader than you might think. It is not just your pension or your paycheck if you still work a little. It is what they call your modified adjusted gross income. In plain terms, that is most of the money that showed up on your tax return. Your withdrawals from retirement accounts, the gains from selling investments, your interest, your dividends, and yes, even a portion of your Social Security itself. They add it all up into one number, and that single number is what decides whether IRMAA comes knocking on your door. So take a step back and look at what we have, a surcharge, based on income from 2 years ago. Using a broad definition of income that sweeps in almost everything, on its own, that would already be a headache. But now let me show you the piece that turns this from a headache into something genuinely painful, the cliff. Here is what makes IRMAA different from almost every other tax you have ever dealt with. Most taxes in this country are gradual, When you earn one more dollar, you pay a little tax on just that one extra dollar. It is smooth, it is gentle. Step over into a higher bracket, and only the dollars above the line get taxed at the higher rate. IRMAA does not work like that. IRMAA works like a set of cliffs. Picture a series of income lines, what the government calls brackets. As long as you stay below the first line, you pay nothing extra, zero. But the moment you go $1 over that line, something very different from a normal tax happens. You do not pay a small surcharge on that $1. Instead, you get lifted up onto the entire next level, and the full surcharge lands on you, the whole thing, for the entire year. Let me make that real with the actual 2026 numbers. For a single person, that first IRMAA line sits at $109,000 of income. For a married couple filing together, it sits at exactly double that, $218,000. Now, stay $1 under that line, and you pay the standard Medicare premium, which in 2026 is $202.90 a month for Part B. But cross it by a single dollar, and Medicare adds a surcharge of $81.20 to your Part B every single month. And then it stacks a second surcharge, about $14.50 a month, on top of your Part D drug plan as well. Put those two together, and that is almost $96 a month in extra cost. Across a full year, that is more than $1,100 for crossing the line by a single dollar, and it does not stop at that first step. There are 5 surcharge brackets in all, and each one is a higher cliff than the last. As your income climbs, the surcharge climbs with it, jumping again at each new line. At the very top bracket, which begins at $500,000 of income for a single person, or $750,000 for a couple, the Part B surcharge alone reaches $487 a month. Add the Part D surcharge on top of that, and you are paying well over $500 a month in surcharges on top of your regular premium. That comes to nearly $7,000 a year, purely because of where your income landed. Now, here is the part that stings the most for married couples, and it connects to something I have talked about before on this channel. Each spouse who is on Medicare pays their own IRMAA. So, if your household income crosses that joint line, both the husband and the wife can each get hit with the surcharge separately on their own premiums. 2 letters in the mailbox, 2 higher bills every month. And it gets crueler still. When one spouse passes away, the survivor gets moved onto the single brackets, where the lines are much lower and far, far easier to cross. The very same income that sat comfortably under the limit for a couple can suddenly shove a grieving widow or widower right over the cliff. It is the widow's penalty, wearing a Medicare disguise. The person who can least afford a shock in the hardest year of their life gets handed a bigger bill. So the cliff is steep, and it is unforgiving. Which brings us to the real question, the one that matters for your life. What kinds of ordinary, everyday decisions actually push a careful retiree over one of these lines? Because I promise you, they are far more common than you would ever guess. The frightening thing about IRMAA is that the things which push you over the line are almost never mistakes. They are the smart, normal, responsible moves that good retirees make every single year. Let us walk through the big ones, so you can see them coming. The first is required minimum distributions, or, as you will hear them called, RMDs. Once you reach your 70s, the government stops letting your traditional retirement account grow untouched. It forces you to start pulling money out every year, whether you need that money or not, and every one of those forced withdrawals counts as income. For someone who's saved well and has a healthy account, a single year's required withdrawal can be large enough, all by itself, to lift them over an IRMAA line. You did nothing wrong. You just followed the rule the government gave you, and the same government charged you for it. The second is Roth conversions. And this one is especially painful because converting money from a traditional IRA into a Roth is often a genuinely brilliant move. It can save you and your family a fortune in taxes over the long run. But here is the catch. In the year that you convert, the amount you move over counts as income. So convert a little too much in 1 year, and you can trip the IRMAA wire without ever realizing the wire was there. The third is selling something big. Maybe you sell a stock or a fund that has quietly grown for 30 years. Maybe you sell a rental property. Maybe you finally downsize the family home. Whatever it is, the gain, the profit you made, counts as income in the year you sell. And one large sale can rocket your income upward for that single year, blowing past not just one IRMAA bracket, but several at once. The fourth we have already touched, but it deserves its own moment because it is so quietly devastating. The death of a spouse. The survivor often keeps much of the same household income coming in, but now they face those lower single brackets. A retiree who never once worried about IRMAA while their husband or wife was alive can suddenly find themselves paying the surcharge in the very first year of their loss, and the fifth is simply a good year, an inheritance that lands in a taxable account, a large one-time distribution, some back pay, a bonus from a bit of part-time work. Anything that spikes your income in a single year can echo forward 2 years later and show up as a higher Medicare bill. Do you see the pattern here? Not one of these is foolish. Most of them are exactly what a careful, well-advised retiree does on purpose, and that is what makes IRMAA feel so unfair. It can reach out and punish you for good planning. So the question becomes this: if IRMAA hits you, are you simply stuck with it? Do you just pay and move on? And the answer, thank goodness, is often no. There is a way to fight back, and most people have never even heard of it. Here is the tool that almost nobody tells you about. It is a single form from Social Security, and it is called Form SSAY44. Its official title is a mouthful: the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. But what it does is simple, and it can be worth thousands of dollars to the right person. Remember the core unfairness at the heart of IRMAA. It judges you on your income from 2 years ago. But what if your life is completely different now? What if 2 years ago, you were still working, still bringing home a full paycheck, and today you are retired, living on a fraction of that? Why on earth should you pay a surcharge based on money you no longer make? That is exactly the unfairness that Form SSA44 was created to fix. The form lets you tell Social Security, in effect, my old tax return does not describe my life anymore because something major has changed. And the government recognizes a specific list of these major changes, which it calls life-changing events. Retiring, or cutting your work hours way back, is one of the biggest and most common. The death of a spouse is another. So is getting married or getting divorced. So is losing a pension or losing the income from a property or a business you used to own. If one of these has genuinely happened to you, you may be able to have your IRMAA reduced or even removed entirely with this one piece of paper. Here is how it actually works in practice. When Social Security sends you that letter announcing your higher premium, that letter will also explain your right to appeal. You get the form either online or by calling Social Security. You fill it out, you check the box for the life-changing event that applies to you. You write in your new, lower estimate of income for the current year. And then you attach some proof. That proof might be a letter from your employer showing the date you retired. It might be a death certificate. It might be a copy of a pension statement showing the income stopped. You sign it, you send it in, and if they agree, they throw out that stale 2-year-old number and recalculate your premium based on your real current life. Now, one important practical point. Do not sit on that letter. There is a window to appeal, so when the notice arrives, act on it promptly rather than tossing it in a drawer. And if you are not comfortable doing it alone, you do not have to. You can call Social Security directly, and there are free counselors through a program in every state who help seniors with exactly this at no cost. I cannot stress this next part enough. Every single year, countless retirees just pay the higher bill month after month because they assume it is final and permanent, and because no one ever told them this form existed. They leave real money on the table year after year. Do not let that be you. If you have had a genuine life-changing event, filing that form is not a favor you are begging for. It is your right, and it can put real money back in your pocket every single month for the rest of the year. Now, I have to be honest with you here, because this is exactly where a lot of what you read online gets it wrong. Form SA44 is powerful, but it is not a magic wand that fixes every situation. And knowing the difference is going to save you a great deal of frustration and false hope. Here is the key distinction. That form is for life-changing events, things that happen and permanently reshape your income, like retiring or losing your spouse or a divorce. It is not for a voluntary one-time choice that simply handed you a big income year. So if your IRMAA was triggered because you chose to do a large Roth conversion or because you sold a stock or a property for a nice gain, that is not a life-changing event in the government's eyes. Filing the form for that will usually get you a polite no. But here is the good news, and it is genuinely good news. So take a breath. When IRMAA is caused by a one-time spike in your income, it is almost always temporary. Think back to the 2-year look back. If your income was high in one particular year because of a sale or a conversion, then 2 years later, that is the return they judge. And yes, your premium goes up, but it goes up for a year, maybe 2 at most. Once your income settles back to normal, and a normal, quieter tax year rolls into that 2-year window, your IRMAA falls away all on its own. You are not stuck with it forever. You are renting the surcharge for a season, not buying it for life. So the real fix for one-time income is not a form at all. It is planning. And this is where just a little bit of foresight pays off enormously. If you know a big income event is coming, you can very often soften the blow or avoid it completely. You can spread a Roth conversion out over several years, converting a smaller slice each year, deliberately staying just under the next IRMAA line. You can time the sale of an investment so that the gain does not land on top of an already high year. If you are married, you can plan ahead for the hard truth that the surviving spouse will someday face those lower single brackets. None of this requires being wealthy or sophisticated or hiring a fancy advisor. It simply requires knowing the lines are there before you go and cross one. So here is the 2-part rule to carry with you. If a genuine life event lowered your income, use Form SSA 44 to fight the surcharge, because that is precisely what it is for. But if a one-time choice caused it, do not panic and do not waste your energy on an appeal that will fail. Instead, know that it is temporary and plan your income ahead of time so that you never trip that wire in the first place. Before we wrap up, let me warn you about the traps around the trap. Because IRMAA does not just cost people money directly, it costs them even more through a handful of simple, avoidable mistakes. Let us make sure you do not make any of them. The first mistake is ignoring the letter. When that notice from Social Security arrives, it is easy to feel defeated, to assume nothing can be done, and to just quietly start paying the higher amount. But that letter is also your notice of your right to appeal, and that right has a deadline. Every letter you leave sitting unopened in a drawer is money you may be giving away. So open it, read it, and act on it while the window is open. The second mistake is assuming IRMAA is permanent. We just covered this, but it is worth repeating because the fear is so common. If a one-time income event caused your surcharge, it is temporary. Do not rearrange your whole financial life in a panic, thinking this is now your forever bill. In a year or two, as your income normalizes, it very likely lifts on its own. The third mistake is forgetting that both spouses pay. I have seen couples plan carefully for one person's premium and completely forget that if the household income crosses the joint line, the surcharge lands on both of them separately. When you plan for 2 bills, not one. The fourth mistake is trusting bad advice, and there is a lot of it out there. Be very careful with anyone who promises a magic trick to make IRMAA disappear, or who pressures you into a complicated product to dodge it. Real IRMAA planning is not exotic. It is spreading out income, timing your sales, and filing a legitimate form when you have a real, life-changing event. If someone is selling you something far more complicated than that and rushing you to sign, be skeptical and talk to a professional you already trust. And the fifth mistake is simply not checking the math. Social Security is working off a 2-year-old tax return, and sometimes that information is wrong or out of date or does not reflect an amended return you filed. You have the right to question it. If the number they use looks wrong to you, do not just accept it. Contact them, ask how they calculated it, and correct the record if it is off. It is your money, and you are allowed to make sure they got it right. Let us bring it all together, because this is one of those rules that, once you truly understand it, you can never quite unsee. And that is a good thing, because it will help you make smarter decisions for the rest of your retirement. So here is the whole picture in plain terms. IRMAA is a surcharge added on top of your Medicare premiums when your income crosses a certain line. It is based on your tax return from 2 years ago, which is why it always seems to arrive out of nowhere on a delay. It works like a cliff, not a gentle ramp, which means a single dollar over a bracket can cost you well over $1,000 for the year and much more at the higher levels. And the everyday things that push good retirees over that line are the normal ones. The forced withdrawals from retirement accounts, the smart Roth conversion, the sale of a home or an investment, and the quiet, cruel arrival of the single tax brackets after a spouse passes away. But you are not powerless in front of this. If a real life-changing event lowered your income, retiring, the death of a spouse, a divorce, the loss of a pension, then Form SSA 44 is your right, and it can reduce or completely erase the surcharge. And if a one-time income spike is what caused it, take a breath, because it is temporary. And the real solution is to plan your income so you stay on the right side of those lines. So here is your one assignment this week. If you are on Medicare and you have ever received one of those letters, go and dig it out and read it again. This time, read it knowing what IRMAA really is, and knowing that Form SSAI 44 exists. And if you are not there yet, but a big financial move is sitting on your horizon, a conversion, a sale, a change in your work, then pause and ask yourself one simple question. Will this push me over an IRMAA line 2 years from now? That single question, asked at the right moment, can save you thousands of dollars. If this helped you finally understand a rule that quietly costs retirees so much, do me a favor and subscribe so the next one finds you. Share it with your spouse and with a friend who is on Medicare, because this is exactly the kind of thing that nobody warns us about until it is already too late. This is Henry Cole. Thank you for spending this time with me. Take care of yourself, take care of each other, and I will see you in the next one.